Good morning, everybody. Welcome to Thursday. Happy Thanksgiving for any of our Yank friends who are up this early in the morning. Don't know why you'd want to be up this early in the morning in your day, but there we go. Happy Thanksgiving to you. Good morning, Kay. Morning, Stel.
Good morning.
Morning. Did you say
US friends?
Did you say young or yank?
Yank.
Okay.
The yin and the yang.
The old Yanks, the old colonials across the water. Let's get them all rolled up first thing in the morning.
How are you, Ryan? Everything all right?
Yeah, good, mate. Good. You?
Good stuff. Yeah, not bad. Same old, same old.
Yeah, got a few moves today, haven't we? Bits and pieces moving around. So nice to see some action today, at least in between the football. Let's get stuck into it then, because I've got quite a bit to get through today. A few things happening. We're going to start in China. Now, we've had a bit of talk out about the PBOC and whether we're going to get a RRR cut, a reserve requirement ratio cut. This came out pretty much as we were on the show yesterday, that one of the Chinese cabinets apparently will make a reserve requirement ratio cut at an appropriate time, and some people are touting this to be maybe this weekend or at least in the next few days. They said that Q4 economic operations will be very important for full year growth. This was all pumped by state media. But it's also, we're still getting some Chinese bank analysts or financial firm analysts coming out still saying that the PBOC may be limited in what they can do on the easing side, and easing measures may be coming to an end due to possible reopening and possible inflation pressures building. So there's some in China, at least on the ground, banks thinking that if we do get an RRR cut, it may be limited in its impact and the last time they ease for quite some time. Now, all this is coming as we're seeing further issues with COVID in China. They hit daily cases hit nearly 30,000, which was up at the most since the pandemic kicked in. Kay, I just caught you popping something up that Beijing's potentially going to go into lockdown.
Yeah, CGTN, but it's CGTN America, right? But it says it's a China state-affiliated media saying that as COVID cases are on the rise in China, cities including Beijing are going back into lockdown.
Okay, so that's potentially going to be a big hit to China, and at least to dwarf this reopening stuff that we keep getting. That may be something that tips the hand on the PBOC to take further easing measures. Now, just so we can make it clear what the RRR is, it's the reserve requirement ratio. It's the amount of cash banks have to hold as a percentage on their books in reserve. And it's seen as a form of easing because if you lower the ratio, the percentage, banks can release that cash. And it's almost a form of, I won't call it QE, but it's supposed to release cash so that can go into the economy and help boost the economy. It goes to lending. It enables, parts of the economy to get moving and to be able to take loans and that sort of thing. So it's part of the easy measures and one of the big moves that the PBOC can do to get money flowing into the economy. So that's why usually it can be a big deal, at least initially. Now, often Aussie dollar can move quite well on RRR moves. Usually when they raise it, you can see Aussie dollar jumping. There is a thought that cash flows in and out of the country as these ratios get changed. So that can lead to foreign currency buying as well. So if we get a move like that, it's not often huge. Something like the Aussie dollar, it can move maybe 30, 40 pips. Obviously, in the yuan, that may be a little bit more. The market has, I think, already pretty much traded around the headline. I'm not sure what the move will get. Will be anything of note outside of a knee jerk, at least to kick the yuan out of this range, or dollar yuan out of this range. If they do go, it's obviously likely to push this higher. But if we can't break those highs up at 718, then we know it's fully contained. And what do you make of it, of the RRR, Kay?
Well, yeah, as I was saying on the chat, it's as you say, but in other words, I mean, in the facts, I reckon it just gives. It's supposed to free cash to what they like would be more lending to businesses, but in my opinion, it's going to be a synonym, at least for a part, of buying more foreign currencies and putting stress on the CNY. Yeah, it's a bit you get more into risky assets as well, and it's a bit like the Japanese were doing, right? So yeah, in the spirit, it is to allow more support, but in the actual facts, I wonder how big a percentage of it would go into the actual economy right now. Did you hear me? I can't.
I heard you. I can't hear Ryan though.
I heard you, mate.
Yeah,
I was just saying.
Microsoft. Yeah, okay.
Yeah, can you hear me all right?
Yeah, now good.
Yeah, cool. Yeah, I was going to say that falls into what you were saying, falls into the next line I was going to talk about, which was a story that we've heard before about China state banks pumping money into the property market and to developers. And the latest is that they're going to pledge at least 31 billion to developers. Now, obviously, if you want to go increasing the cash available, then an RRR cut is one of the means you can do that to get it pumping. So there's method in the madness, let's say that. There's always a plan from China. In terms of dollar yuan, as you said, you know, we look at the situation now. There was a lot of positivity coming in about reopening. That seems to be going backwards at the moment. If we do hear of cities locking down again, that's going to be negative for the yuan, and we're likely to see dollar yuan climbing back up, probably up into the 720s, 730s, which will please me and Kay, who are sitting on longs. Are you still in your longs, mate?
Oh yeah, man, and I had that again this morning.
Yeah, so
and I had it again on the lockdowns. So yeah, I've got a bit.
Good. So yeah, I'm happy to sit on that side for now, as the news is seemingly on our way. Let's have a look. Just seeing some headlines dropping. Right, and still in China, we've had obviously a lot of chatter that looks to be conciliatory, various governments and meetings with Xi and whatnot, but a China official was out saying that Taiwan's 24 nautical mile line doesn't exist and that it's unlawful and invalid. So they're still making noises about that Taiwan situation there. Over to Europe, Riksbank hiked rates 75 pips as expected, rates now up to 2.5%. Their forecasts show that the policy rate will be raised further at the beginning of next year and then be just below 3%. So onward hikes for them, at least 25, 50 basis points coming likely from them. Much reaction in the Sweden, Kay, on that move?
No. Actually, no, we didn't move a lot. Euro stock, it was 1086, trading 1088, but it's more
Nothing.
Bit of a dollar move than anything else, in my opinion. Yeah, a load of nothing in stock. It was very well telegraphed, right?
Yeah.
They did say they also have a quite clear communication. Their communication is always very clear as well, and that's changed as well over the pandemic, because before it was like really impossible to know what they were going to do. But since then, the communication channels are very clear, so everything is in there, so the market can anticipate and know exactly what they have to expect from the Riksbank. So the moves are very subdued. If you look at euro stock, for instance, which is the proximity trade, right? We often say that Swedish krona is the accelerated euro. It's still a bit the case. Yeah.
That's the only one I haven't got my chart there, but on my list. So yeah, you can look at that later. Just to answer Saurabh, do you think there's quite a bit of movement already today, given it's Thanksgiving? Yeah, Europe is fully open, so it could be that it's going to go quite later on this afternoon. But so far, yeah, there's plenty of going on, plenty of movement in markets at the moment this morning. I think there's a lot of the China stuff coming out. It's going to produce global growth worries. We've seen the PMIs not be too great, particularly in the US yesterday. We've seen that in Europe. So there's a whole global recession picture that looks to be rearing its head, and it's driving yields lower. And JPY seems to be the yen seems to be one of the bigger drivers this morning. So yeah, plenty to go on. And you know, as we've been mentioning this week, there will be lower liquidity, which means things may move a bit more than they would normally. Over to the Bank of England, BOE's Pill said they need to double down on their 2% inflation target. So always nice to hear central bankers talking like gamblers, which is pretty much what they do day to day. The ECB, Vasile said rates will need to go beyond neutral level next year. He sees the current tempo of hikes as adequate and says we'll continue in December. So that puts him in the, I would suggest, a 75 pip camp. I looked at the rate probabilities this morning. It's 80% probability for a 75 pip hike, 20% for a 50. So the market is still leaning towards 75 pips for the ECB going into the meeting. Obviously, that puts the price risk if they only go a 50 or even less. So that's where the price risk sits at the moment. It's all fun and games at the ECB because Slovakian police have charged their central bank governor Kazimir over bribery. That was in the Slovak media. He's quite a hawkish member, one of the most hawkish members of the ECB. So if he's out the game due to these charges, allegations, he has to step down. That's potentially a hawkish voice out of the governing council for the next meeting. We'll see whether that happens or not. Over to the gas price cap that we were laughing about yesterday. Well, Spain's PM Sanchez said the gas cap proposal could lead to price increases, which is completely the opposite of what it's supposed to do. Exchange ICE, the ICE exchange where gas is traded, said the EU price cap could deliver a 33 billion blow to market. Basically, the gist of this story is that the price cap is going to increase, if you like, risk premium for futures contracts, meaning they will have to hike margins to cover that potential risk for the forward months. So that's going to mean potentially a lot of margin calls and then a lot of increased costs. All going to plan in the EU as usual. Over to Mexico, and they're not ready to decouple from Fed yet. So keeping the rates in line mostly with rate increases alongside the Fed, and that they still need to keep increasing the key rate. Not too much different to what they do anyway. They pretty much follow the Fed, don't they, Kay? But do you think they're going to slow down at the same time, or how high are they going to keep hiking until if the Fed keep doing so?
Well, yeah, I think they will slow down same time as the Fed. They are at 10%. I don't see what they will do else than the Fed really right now. But if the Fed slows down with the level of where the interest rates are in Mexico, well, I'm starting to think at least that we will see perhaps what Powell has to say as well next week. But I'm starting to think that perhaps time has come to take a closer look at the mix again. Perhaps wait for the end of the month. I don't know, but So $MEX is pretty stable right now. EuroMEX, yeah, doing a real yo-yo between 20 and 2020 right now. But I've started to take a closer look at it again, because those tops keep on the tops are being rejected all the time. So but yeah, back to your question, I don't see any reason why they would decouple from the Fed right now, because their economic data are not really decoupling much from those of the US either.
Yeah, thanks, mate. I'm just noting Casimir is out with a statement saying the charge of bribery is an absolute lie and that he did not commit a criminal offence. I don't know if he means that the charge is a lie, that or the headline that the charge was laid is a lie, or that the charge itself is a lie. So anyway, he's issued a statement. This is something that has been going on for quite a while. Accusations were flung around, I think, earlier this year, while investigations took place. But anyway, he's out with a statement saying it's the charge of bribery is an absolute lie, and we'll see where that leads. Right, give me a second. I'll just get myself straight. Where are we? Yep, still with the ECB. Centino said 75 pip hikes cannot be the norm and sees a lower increase in debt. Bit of a repeat there. Coming over to the Fed, we had the Fed minutes, which on the whole, it reiterated what we sort of heard before Powell spoke, that rates would have to start slowing soon. And officials are seeing that rates will have to slow down soon. But it also re-emphasized the view that the Fed members are looking at where rates are going to get to, rather than the pace that they're going to get there. Various officials saw rates peaking at a higher level. A few officials wanted to see more data before they slowed the pace of hikes. And a few saw some considerable uncertainty on the rate peak. So it's all pretty much up in the air, these minutes. I would say, as I said, on a little slant, they're probably sounding a bit dovish. Maybe why we're seeing yields a bit lower. There was nothing really strong in there on the hawkish side. But I still think there's plenty of room for that to be countered, either by Powell or the next FOMC, in terms of reinforcing the message that rates are going to continue rising and will be held for a long period at high levels. Stel, what did you make of the Fed minutes, if you caught them?
Yeah, well, the market liked them. So basically, they are, most of the members are now supporting slower hikes, basically, than 75s. Kind of makes sense, because even Powell has said that eventually, we have to reduce the pace. I think now, if you look at Fed Fund futures, actually, hold on. Let me take the screen for a little bit, just for a little bit, okay?
Yeah, go ahead.
Hold on. Continue. There we go. So if you look at Fed Fund futures, there's a really good way of gauging what market's pricing. The next meeting is on the 26th, 27th of January. So if you after December. So we're trying to figure out what's December's pricing. So if you look at January Fed funds, if you subtract November, which is basically with the current rate, where we have rates now, so 96.21, let's say 22 minus January 95.63, that gives you 59. Now the meeting is actually in January on the 27th, so you have a few more days, like 4 days of higher rates. So you could argue that Fed Fund futures are pricing 50. I could do the mathematics, probably 51 or 52, something like that. So it's going to be just a smidge higher than 50 priced for December. I used to do all that, by the way, when I was market making Fed Fund futures and interest rate swaps. So this is a very simple way of calculating these, but you need Excel, and I haven't done, I don't do this now because it's not part of my job anyway. So the market's pricing just above 50. Do we think this is fair? I think that's fair. I find it hard to see how the Fed's going to do 75 without something major changing between now and December. The question, though, is what do we think the terminal rate's going to be? And what are Fed Fund futures telling us? Look, the lowest price is June, 95.02, so 498, so call it 5%. Do we think this is fair? Obviously, it's market price, so it has to be fair. What do we think? I think that's probably on the low side. I think, if you put a gun to my head, I think they're going to be hiking more than that. But I think the pace is going to be slower. So what does that make? What does that make with the markets? It's a tough one. I still think that the language on the December meeting is going to be, I think they're going to do 50. And I think because they're kind of preparing us for that now, right? The minutes yesterday, that's roughly what they're guiding. But I think that the language is going to probably show that they're going to be doing more than the market is expecting in total. And that the expectations of rate cuts, you see here we have 95.02 in June, and then we have a full cut priced by November. I think they're going to lose whatever credibility they have left by cutting straight away. So I think there's a good chance that they're going to stick at their terminal rate, whatever that is, and then take longer to start cutting. I mean, there's going to be a need for something drastic happening to the economy for them to start cutting. What do we think overall? I still think the danger is, anyway, I'll give you back the screen now. I just wanted to show the Fed Fund futures.
Keep that up there, mate, because I just wanted to explain to anyone who doesn't know about, interest rate futures trading there, that those prices that Stel was pointing to there. So let's say that top one in May, 95.03, let's call it 95. Pricing is based on 100% or 100 figure. Yes. So if it's 95.0, that suggests an interest rate of 5% because it's the difference between 95 and 100. So that's how you tend to calculate what the interest rate is expected by that price there. So it's the difference between 100 and the price.
Correct, yes. Correct. Sorry, I didn't mention that. I should have done that.
No problem, mate. That's what I'm here for. Help you out.
Yeah, yeah. So I this is my view on what I think the Fed's going to do. And we're seeing yields dropping more. Anyway, I'm going to take the charts afterwards, maybe show a couple of charts, but I think the risk is growing now for a disappointment. I've always said that I think that Powell is going to disappoint. I think the more yields drop, the more the dollar drops, the more risk goes higher, the more danger we are heading. We have of them disappointing more than the market thinks. So that's what I think. But anyway, I'll go through a few charts afterwards, finish up what you're doing, and I'll do that.
Back on there. And I was going to share this as well. Pretty much echoing what Stel said there. You can see the latest probabilities. These are made up. Another metric that's used to predict where rates might be. It's pretty much based on overnight index swaps and SONIAs and various other measures of short-term rates. But there you can see the Fed 50 pip hike priced at 65.5% versus 34.5% for a 75 pip hike. So pretty much in line with what Stel was pointing out there from the rate futures, that a 50 pip hike is taking the lead, if you like, in market expectations. But as I'll repeat, what that means, how that's important to us in trading is it tells us where the risk is going into the event. So if everyone's expecting 50s and they put a 75, that will be the bigger price shock to markets. That'll bring the bigger move than if they actually dropped what was expected. So that's why it's important to look at these metrics, to look at these expectations going in, literally 5 minutes before the meeting, to see where your risk really lies in terms of price moves. So as you can see there, that's the Fed, ECB, forget the Bank of Japan, and obviously the BOE there too. Right, let's get a shot of that. Right, let's get through some of the other headlines. Bank of Canada's stiffers, Tiff Macklem was out saying that he expects policy rate will need to rise further but how much further will depend on how monetary policy is working to slow down demand. Inflation in Canada remains high and broad-based, and they've yet to see a generalized decline in price pressures. Tightening phase will draw to a close. They're getting closer, but they're not there yet. That's him in Canada. Right, now, just one other story I pulled out this morning from one of the freight newswires or presses, that there are now 0 ships waiting off the South California port. For the first time, it's had 0 since October 2020. There are 59 odd ships off other ports in the US, so the queues, there's still some queues there. Usually it's in the single figures, but this news means that the hell of a lot of the backlogs that we saw in US ports coming after COVID are being cleared. That's potentially a bit of a help for the Fed on inflation, because that means that goods moving swiftly and getting to destinations can take out some of the price pressures, people having to pay up maybe more for other goods from different sources if they can't get them through the usual channels, i.e. shipped over. So maybe we'll add to some easing of inflation too further down the line. It may be a while till we see that in full effect. We may already be seeing some of that as these queues have been dwindling, obviously, over time. Jane, yeah, fair point. There is the possibility of a rail strike. I don't know the latest. We covered that, I think, beginning of the week or late last week about the rail unions in the US. Seems half of them want to sign the deal and the other half don't. So that's still up in the air. And then you've still got the same price pressures and supply chain pressures if they do strike. But as far as the ships go, it's all looking tickety-boo over there. Let's have a quick look through the data. Where am I? Over there. Some numbers out of Japan overnight. PMIs softer on manufacturing, dipping into contraction there, missing expectations. Services as well, pulling back to the line in the sand at 50 versus 53.2 prior. Leading index in Japan as well was up just a pip. That's been moving pretty much the right way, but we have seen some signs that the improvement we've seen in the Japanese economy may be starting to falter just a little bit. There was some other data out, final numbers for machine tool orders. They were down 5.5% versus the prior minus 5.4%, so a bit worse there. Coming into Europe, IFO was a little bit perkier. Expectations there coming in at 80, decent jump there. Current assessment, a little bit softer, but not a complete collapse. It's given where it's been going through the rest of the year. That's quite a surprise. The index overall, a bit more positive, 86.3 versus 84.5% prior. While we're on the IFO, they also, the economists report and their messages, and they said that 46.8% of companies surveyed want to raise prices in the coming 3 months. That's less than 50%. So it's showing potentially that price pressures are going to be easing perhaps in Germany. If the balance is above 50, that means more are going to raise prices than not. So that could take a bit of steam out of inflation over there. Well, I think that's it on the data front. You guys got any more headlines? Because then I'm going to look at what's going on in Hong Kong dollar. Kay, you got anything you want to add?
No.
No, go for it, man.
Okay, so Hong Kong dollar. This is one I've been trading, as you guys and girls will know, trading on the top of the band. Now, what we've had over the years is people trying to take on this Hong Kong peg, and the latest is Mr. Bill Ackman and his Pershing fund, and he's taking what's been called a large notional short position against the Hong Kong dollar. So he's expecting the peg to be blown to the upside. He's not the first, he won't be the last. He last had a crack at this, as far as I can recall, back in 2011, and as far as I'm aware, he came up short in that one. 2019, we had Carl Bass dipping in and playing that all the way through 2021 before he lost all his money. He was playing it via options as well on the other side, I think. And all his options expired worthless. And it was even said that he took money from Steve Bannon, who was Trump's old mate, and that all blew up in his face as well. So there's been a few people having a crack at the Hong Kong peg. And when they do so, they tend to end up with egg on their face. Me, I'm just a simple trader. I just trade the levels. We've got a defined top and we've got a defined bottom, and I'm happy to play in the middle of that. Price-wise, we're sitting right in the middle there. I don't know if he's going to make money on this trade. It mean that the peg needs to probably blow at the top, which is probably a tough ask. But it's good entertainment for us to watch how these big funds like to take on the market sometimes, and when they get a bloody nose. What do you make of it, Kay? You were playing the other side of Bass last year, weren't you?
Yeah, yeah, but that I mean, it didn't blow. So it's a peg that's been kept for 30 years. Perhaps it's like really perhaps and maybe and whatever, we don't know. Perhaps when China will go full steam back into reopening, trying to regain investments and stuff, that we might see some move, perhaps because they want to decouple from dollars and things. But that's going to likely take another few years before they think about it. And anyway, HKMA said last year that the peg is here to stay. So who are we to trade against people with $3 trillion in the books, right?
Yeah, exactly. And it is important to note that since Hong Kong has now come under China's wing fully, that the PBOC is probably the big influence. So if they do decide to change things around, it's probably, as cases, probably now's the more likely time than not when they were their own independent authority. But yeah, you know, it's a trade when you got a central bank at your back. That doesn't happen often. You know, you might as well give it a go. So I'm still in shorts there. And if we get down to 775, I'll look to reverse into longs and do the opposite on that front. Right, so looking at some of what's going on this morning, we're getting some decent moves. It is a bit of a yield story. We're seeing yields coming off pretty much around the bond space, if you want to call it. 10's looking a bit iffy down here. Want to keep an eye on that. If they break these recent lows, we could have a bit more follow through, and that will suck the dollar down with it. If we get through here, this 3.67, 68, we could be getting a move down to the 3.50s, which will be the next big level. It might be a dodgy time because of the liquidity drop in the US. It might mean that things run a bit further. Bond markets, I'm just checking out.
The bond futures are saying that we are well through it. I don't know the formula to calculate it, but we're at the highs of the 10-year note futures. So
yeah, so just keep an eye, because some of the feeds might not be reflective of what's actually going on, obviously, because
the feeds are stale today in the yields.
Yeah, exactly. So keep an eye on that. But either way, the rest of the yields space is open, so we can keep an eye on euro yields and things like that. As you can see, we're getting these moves lower. It can create some air pockets if liquidity is lower. So keep an eye on dollar yen. It continues to fall at the moment, as are many yen pairs. So as I mentioned at the start, is a bit of a yen move we're seeing across the board, being the main driver, as you can see. So it's always good to know which way the wind's blowing and who's moving what at the moment from those yen pairs there. Aside from that, you know, there's not really any fundamental reasons for why we've got some of these moves. Cables breaking up through 121. Again, it's a bit more of the leash is off really for the pound. There's not really any further bad news for it at the moment, and the volatility there is lifting it higher. Euro's a bit more constrained, as it often is. I'm keeping an eye on euro sterling in regards to the pound, because we have got down to this next area, down 86, 85, 80, 90. Going to be a bit of a level down here, probably down to about 70. If we get through there, then maybe we're going to head to the low 85s, and then I'm going to start getting itchy to start picking up some longs again down there. But we'll see what happens there. For the rest of it, just more management really on some of the trades. Aussie dollar back up through the levels. Maybe we'll get a look at up towards 68s again. I may consider that for just a short-term short up there, even though I'm core long, just to play the level. If we get up there, it's a pretty decent level. These are the sort of levels I'm going to be looking at to fade any moves, or where the stretch points may come in if we're just seeing this low liquidity conditions trading on at the moment. Gold also has had a move up. There we go, back into this zone. Really needs to get above here, above the 60s area, 70s, for a pushback higher, maybe towards those highs, maybe up. Again, I'm not sure we're going to see those highs get broken unless there's something freaky happening. So if you're looking to play these moves at the moment, look at those big strong points. Those are the areas you want to lean on. So up at 1780, maybe 1775 might be the area to potentially look at shorts, just to counter these moves today. So really, I've got my sniper rifle out. I'm not doing. I'm not looking at taking any sort of big trades. I did try a little bit of a dollar yen long this morning at 138.69. Just playing the. Let's get a chart up, then you can see what I'm talking about. So I just played a long just off that fib, that old fib there, which got blown out, and we've seen it dip further. I may have another little look long down here against that prior low in the 137s if seen. I've been saying that if the fib minutes gave us some dovish news, or the market moved negatively, spoke about on Face yesterday, I would look to maybe pick up some dollar yen, but I'm not going to go out on a limb on it. I'm not going to throw the farm on it. I tried a small one there, didn't work. I might try a small one there with a tight stop. If it doesn't work, I'll be out and see where it goes thereafter. Stel, did you want to take a quick run around the houses?
Yes, sir. Okay, so I'm going to be pretty brief because it's not that much. Go on.
Yeah, just because you were talking about the yields, right? So I'm just going to add a couple of things. So first of all, we've seen huge future moves, and last time that we've seen stuff like that was during the big decline of dollar yen, which was sparked at first due to interventions probably, but then recall when the CPI came out in the US. Apparently, there were record volumes of US bond futures going through on the 10s, which caused that nasty drop lower in dollar yen. And of what I'm reading, there has been another round yesterday into and after the FOMC minutes, which explains why the dollar yen is getting hammered a lot more than the rest of the dollars being bought, being sold. Even though they all made headway, but if you look at the yen crosses, they've gone actually down quite a bit compared to the yen has gone a lot faster than the rest, which is to be explained by all these bond futures going on. And just having an update from Five Magics in our room. Apparently, somebody bought 97, 98 call spreads in the short in the SOFR tenors. So they think that in 2023 we might be closer to 2% monetary policy rate again. That's the best that people are putting on right now, which is a bit crazy in my opinion. But just to give a little background about why and how these these markets are trading. And if you look at why FX is doing what it does, is that's because you have a lot of correlation algos turning in the market. So even when there's not a lot going on, when there's no big corporate interests or whatever, those correlation algos, then they will have the free ride or the free drive, let's put it that way, and just correlate FX with what's going on in the bond market. For what it's worth, looking at the futures market now, that would put us closer to 360 in the tens, where we closed at 368 yesterday. So be a tad careful, because those future moves, in my opinion, overdone right now. But those future moves, they point at a reopening of the markets at quite different yields. So
Thank
just
you,
wanted
Kay.
to add this one.
Thanks, mate.
Thank you. Okay, so I'm going to be relatively brief, because let's face it, it's holidays today. So I always look at yields first. Yes, the market's closed today, and Kay correctly said that we're implying lower levels if they were open. We still have to point out that there is a pretty important area around here, around the 360 to 360. Well, these lows here, 367. So this is a pretty important area that, you know, I think we need to be very careful of. And remember, we have a Powell next week speaking. Is he going to give us more monetary policy clues? We don't know. But if you recall, last couple of weeks, what have we been saying? We've been saying that going into Powell, we will probably grind, lowering yields, lowering the dollar, and higher in risk. And this is exactly what's been happening. Obviously not huge moves, but cumulatively it's been adding up. And we've been talking about the S&P 40, 50 to 40, 100. And look, we're at 40, the futures are trading, right? Yeah. So, you know, we're getting there. And I think this is going to be a really nice level to try to fade. Again, like Ryan said, these markets are a little bit weird. So I'm going to try and fade this if we get close to this 1490, wherever it's going to be, you know, wherever this thing comes in on the resistance trend line, but with a tight stop. I'm not going to risk much, but I think the Fed, I will say it once more. I think the risk is becoming more and more that the Fed will disappoint this very happy and buoyant market. They expect a 50 now, and the rate of change of rates to go down dramatically. Actually, a 50, and then what? Another 60 basis points, I think, of hikes, and that's all done. Which I find it a little bit. You know, a little bit optimistic in terms of how quickly the Fed's going to stop. Now, having said all that, I do think, and I've said this before, I do think inflation is going to start dropping quite quickly in the first quarter of 2023. And, you know, simply because of the way it's calculated and because of all other, a whole lot of other reasons. Ryan, you talked about shipping rates, or was it Cayman? I have a couple of ship owner friends who go to the gym every day in the morning, and they were talking today about how rates have dropped dramatically, and obviously for them it's not a good thing. But and let's not forget, 90% of all global freight is done via shipping, so this is hugely important, the shipping rates, and so these have been dropping, and the effect of all these is never seen within the next day or the week or month. It always has a lag, so we're going to see that. I think it's going to be like a triple, quadruple whammy in the first quarter of 2023. And I do think that inflation is going to go quite a bit lower. Now, how much has the Fed, or will the Fed have tightened before? I think they're going to do 50 in December, probably going to do another 50 in the end of January. And that takes them straight away to where the terminal rate is being priced now. So that's why I think they're probably going to be doing a little bit more than the market's pricing. But then I think they're going to stop, and as inflation drops, they're going to be turning the way they, you know, the language is going to become more dovish. But again, I don't think they're going to turn around and start cutting straight away. That's going to look it's not going to look good. I mean, it really isn't. But I think the market wants to see and wants to know, when is the end coming? Where is the end of rates? Because then we can get some stability in rates, in bonds, and then things start moving from there. I do think that bonds always lead. So even if, let's say, bonds stopped dropping here, I do think that the stocks will underperform afterwards, you know, for the next few months, let's say, and this is simply because bonds always lead the way up and down. I mean, that's historically how it's been. Obviously, not always, but that's how historically it's been. So, currencies wise, what do we think? The dollar is coming right at this 200 DMA, very important level, and it's also the previous lows here. What was that? That was a CPI low, right? 15th, maybe no, maybe a couple of days after PPI low. This was CPI. I think this was PPI or whatever it was. This low is going to now coincide with a 200 DMA. This is going to be a very powerful support level. And also, this is close to these lows before, also these highs here. So you get this range here is a very, very important point of interest. And so I think if you want to be bullish the dollar, you want to wait for the market to grind there. And I think that's going to be a very, very nice risk reward long. And that goes in line with what I think about the Fed. I do think that they're going to disappoint the markets. Powell's going to disappoint a little bit. So I think that's going to bring one final push higher to the dollar. Euro dollar is trying to break out of this 200 DMA, and also again, you know, euro dollar is basically the inverse of the DXY, because we've said this so many times. 50% of the DXY is euro dollar, so a very, very similar picture, but inverted. The cable is interesting. We're talking about this 121.50 to 122. We're getting there again. You know, lows, previous highs. There is a lot of interest here. It almost feels like a lot of the currencies are aligning, and the market seems ripe for either a reversal or a proper breakout. I think the chances are we reverse, simply because, as I said before, I think the Fed's going to disappoint. I know I keep repeating things over and over again. I kind of do it for myself as well.
Old age, mate. Old age.
Old age, yeah. Who are you again? Gold and silver, they're doing okay, but they really should have been doing a lot better. They're still underperforming, all things considered. But having said that, gold has broken out. And by broken out, we mean that 1680, 1690 level or range that was broken quite convincingly. We're now, we tested, you know, we came back to the 1730s, which is a really nice support level. That's probably still the first support. And then again, we go back to 1680, 1690. So that's the downside. It's very clear. And the upside is these highs here, 1785-ish. If that goes, oh my God, I think we're going way, way higher. Silver is underperforming today. It's, you know, I have a very small long now. I got rid of a lot of it a few days ago when it well, I hit my stop basically. I want to add more, but I'm a little bit cautious of the Fed. So for silver to get really bullish, I think we need to get above these highs. Not that far, but you know, it still needs to clear that. Cryptos are trying. Bitcoin's trying to get out of this, you know, wedge flag, whatever you want to call it. But in the grand scheme of things, this doesn't look good. And we've said it before, the trigger for this drop was FTX. And is this an isolated incident? Absolutely not. I don't think so. And there's so much interdependence between all these crypto brokers, entities. I find it almost impossible that it was FTX and then everything's back to normal. So I'd be very careful with cryptos on the long side. Having said that, Ethereum has bounced as well from this 78.6 level. Also was very close to these previous lows. It looks weak. It still does. So be very, very careful with those. That's pretty much all I had to say. I don't have anything else, you know, and nothing else in FX is moving enough for me to really get interested on a long-term basis, on a medium-term basis. Oil is interesting as well. That's another thing I'm looking at, and I think these lows here are very important. 1740. There's also a fib below, so this area of interest here, we're almost there. So, and also the previous lows. So this is not a bad place for a. If you want to get long, this is not a bad place to start looking at it. But again, you know, if this goes, the trap door opens, and you know, where does it stop? I don't know. So,
wait for 70, where the SPR bids are still. We can we can load them up at 70.10, and we've got and we've got some protection down to 65.
Yeah, but it's 10% below here, right? So that's a pretty big number.
Yeah, but look at what it's done already.
Yeah, no, I'm with you. I think this.
And the thing is, if China continues to be on lockdown, there's one of the takers that's not going to be taking as much as they would in normal times, right?
Yep. Anyway, that's all. So hopefully it was interesting and not boring.
No,
I know
very nice,
I repeat myself a lot, but you know the way I look at things.
Yeah. Do we need to have a conversation on the DXY? I feel like, you reckon, Kate? I think we drew a conversation on the DXY.
Yeah, and perhaps flow show is better than face.
Yeah, we can do it while there's no Yanks around to tell us off. Well, maybe we'll have a chat about the DXY tomorrow.
Because it's Friday and nobody's around.
Friday, nobody's around. Let us know if you look at the dollar index a lot.
Don't do it. Don't go there, Ryan. Come on.
No, we're going there. I'm making a decision. We'll talk about the DXY tomorrow. About how I think it's personally pointless for anything at all to do with trading. But that's why we'll have a discussion on it. Still, you'll be around for that tomorrow now, won't you?
Yes, I will. Yeah, I'll be here.
Yeah, good. We'll have a if there's nothing else going on, we'll have a chat about that tomorrow. Kay, do you want to have a look around anything before we call it a day?
I'm looking at the clock, mate. Why don't we call it a day? I mean, there's not a lot. Okay, let me just share two, and that's it. I'm just going to share.
Share more than two. I bet you share more than two.
No, I have to keep my promises. So first of all, dollar CNH, because it's going on in China again, lockdowns, Beijing, and then there's another city that crept back down into lockdown. So we've already talked about this first level around 712, and then with a lot more weighting below. But if you look at even the short-term picture, starting to do a little bit of a yo-yo, and we can't even go and test 712 for now. Of course, news is continuing to come. So if ever we start to pull up again, keep an eye on this 718. We've had like 1, 2, 3 attempts to get back above there and failed right now. So of course, there's a part of dollar playing in there, but the CNH bit looks a tad weak again in my view and in most people's view. So keep an eye on those 718s. If we get through there, there is a possibility that we are going back testing at least some of those higher levels. I was talking about mid 720s. There's a bit of traffic zone here, 722 to 724. I think that's really in the possibilities if we get above those 718s. The other one that I was going to mention is this euro makes it's really going up and down, up and down. Okay, some may say that we are flagging to go higher, but then I'm still looking quite closely at this red trend line coming from 2017, which we broke a while back. When was it? We broke during the summer months, indeed, and we've never looked back. So to me, that's going to be a big zone again, 2040s. It could be enough, you know. It could really be enough. This euro makes here. If now we've had like 1, 2, 3, 4 serious attempts to break above 2020s again. And for the time being, it's capped. So But we need confirmation to turn the ship around again and go back down. We need confirmation below 1994, 1997, in my opinion. So those are two things, not really the majors, but stuff that I'm always keeping an eye on, and that I like to trade because they more often than some other trades are quite clean trades. So that's really it.
You know what that one's setting up like, mate? That Euro, it's setting up a bit like EuroCAD. Remember EuroCAD at that 133, 134 area?
Yeah.
But it was support, remember, for so long, and I'm just wondering if that's developing into something as well. Because I'm itching to drop another break trade in. You might need to come out.
This 134 here.
Yeah.
And
remember
then we
that?
broke below, but
and it went some, didn't it?
Yeah.
I'm just wondering if Euromex is setting up for that sort of thing as well.
Yeah,
I tried a break trade the other day that didn't work, but I'm thinking maybe go above maybe 2025, somewhere like that, for a potential break, maybe even above 2030.
Yeah, but then you need it to happen relatively quickly because you're paying away 7 or 8% funding every day.
Yeah, exactly. Yeah, good point. Cool.
Alrighty, that's it for me.
That's it for you. That's it for me, and that's it from Stelios, I think. So thank you very much for coming to the Flow Show as always. Thank you, RA, for your comment. You like coming to this one because of delving deeper into futures fundamentals, which you find very interesting. Not a great believer in Fibonacci and trend lines. Yep, you use what works for you, mate. Long and short. So thank you very much for coming to the Flow Show. Have a great day if you are in the US, and thanks everyone. See you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.